All right, Chapter 20, investments. Let's start out with talking about some key terms. Let's define some key terms. All right, financial risk. Let's start with that. How would you define financial risk?
Taking a chance that you could lose money on an investment.
Making the risk that you could lose money on an investment. All right, who was invested in 2008? Who had investments in the market in 2008, 2009? During that time period, if you did, you more than likely saw a decline in your investment value. Had you realized that loss, meaning had you sold during that time period and received money less than what you originally put up, you would have just suffered financial risk. You would have just suffered financial loss. Conservative investments. Low-risk investments, such as government bonds or certificates. And when we talk about certificates, I want you to think of CDs. Okay, these are going to be, government bonds are going to be backed by some government authority. If you purchase a United States Treasury bond, it's going to be backed by the full faith and credit of the United States government. If you purchased your state's municipal bonds, they are going to be backed by the full faith and credit of your bonds, or of that bond. So you have an added layer of security, meaning you have that government authority backing it, not just the issuer. Okay. Before we go further, I'll put a disclaimer out that over this discussion, nothing that I say should be received as me giving you financial advice. You should not act upon anything that I give. Any opinion that I give is fully my opinion, not my firm's or not any firm that I have mentioned. And again, you should not make any investment decision based on what I say tonight. Instead, consult with your financial professional. Speculative investments. Okay, these are going to be high-risk investments, such as stocks in new companies, otherwise known as IPOs, junk bonds, or options in future contracts. Okay, junk bonds. These are going to be companies that are issuing bonds that do not have a good credit score. Just like we as individuals are rated, if we go to acquire money, they're going to look at our credit score. There are rating agencies who will go out and assign credit ratings to any company, any government entity, any issuer of a bond. They're going to assign a credit rating to them. Now, those that have lesser than par credit, they're going to have to pay a higher interest rate. Okay, you can bet that a company that is on the verge of a default, more than likely paying a higher interest. If they issue new debt, they're going to pay a higher interest than a company with the highest credit rating. All right, some of these rating companies would be Standard & Poor's, Moody's. Those are your two largest rating agencies. Fitch would be the third. Each are going to have their different criteria on how they rate them, but you're going to see some common form of, you might hear somebody talk about AAA credit being the highest. You might see a pattern like that. Good. If we want to apply the excellent and the good, not as good. Usually, you might also see this as A+, this is B+, this is B, this is B-.
Which is almost average.
Usually your junk is going to be anything rated down in that level. Okay, a diversified portfolio. Who wants to talk about that? What's a diversified portfolio?
You have money in different areas, I guess, of stocks. I guess I don't know how to put it.
What's the textbook tell you?
It says an investment strategy that's a mixture of stocks, bonds, cash equivalents, and other types of investments.
An investment strategy that's consisting of stocks, bonds, and other types of investments. What's the intent of it? Have you ever heard the term, do not put all your eggs in the same basket?
Yeah. Is it kind of,
Imagine that you have in your investment portfolio and you have 100% of your investment in one individual company, stock of one individual company. Is there a lot of financial risk there?
yes.
Yes. But what if we spread that out against different types of investments among different geographical areas? You know, your fixed income among different durations. If you ladies that are zooming in can pull up, if you have access to a computer, I'd ask you to go up and pull up a Callen chart. C-A-L-L-E-N chart. You're going to see one, and I'm going to put it up to this computer now where you'll be able to see it. If I can hold it up. What this is going to show you, and you folks that are zooming in live with me here, or who are live with me, look at this. And I'll pass this around. But you here under a Callen chart, you're going to see each box is going to be variant investments and the type of performance they gave during the 2006 through 2015 time period. And for instance, if we see in 2006, this purple box that's up at the top, this was real estate. So this was the real estate market that gave a 42.4% return in 2006. That purple box is way down here in 2007. And in 2007, it gave a negative 7% return. The very next year, we're back up to 38. Let's focus on this light colored white or gray area. I think it'll probably show up the most. This is going to show what a diversified portfolio did among all of these sectors. And if you notice, you see how it kind of trades right along the middle. Less volatility up and down. Those are the effects we set to generate and hope to generate using diversification. You know, if I look down here to 2006, the worst performer, commodities. Okay, commodities can be everything from oil to natural gas to gold to pork bellies. 2007, 16%. 2008, here's our decession years. negative 35.6% return. You can see how timing that market can be very difficult. I'm going to tell you, timing that market can be impossible. Timing it with absolute accuracy. Okay, when we talk about diversification, we want to look at holding a range of investment options of varying characteristics so that we can produce less volatile returns. I'll pass that around. All right, we talked about stocks. You're sometimes going to hear me refer to these as equities. Probably from this point further, I will refer to them as equities. When we're talking about equities, we're talking about investments that represent ownership in a company. You are the owner in that company. You are a shareholder. All right, when we talk about a share, we're going to talk about 1 unit of ownership in that company. So you call up your investment advisor and you purchase 10 shares of General Electric. You own, your ownership is represented by 10 shares in that company. They will issue you, if you request, a stock certificate. Now, stock certificate is going to be a printed piece of paper that's going to show your ownership. And we'll look at a stock certificate here in a minute. You said you were a shareholder, and if they do decide to pay, they being the company, decide to pay any dividends, you are entitled to those dividends as the owner, according to the terms that they set. Publicly held companies. Here we're going to be talking about a corporation whose stock is available and bought and sold to the general investing public. These are going to be ones that are trading commonly up on the New York Stock Exchange, the NASDAQ, or some other public exchange where individual investors are able to buy and sell shares in these companies. Common stock, a class of corporate stock in which the investor has voting rights and shares directly in the success or failure of the company. This is going to be your most common type of ownership. And you are the owner. Again, if there are incomes and profits at the end of the year, and those profits are going to be distributed in the form of dividends, you're a common holder. You have the right to be entitled to those. The same thing, you share in the losses of the company. If the company has a history of paying you a dividend and all of a sudden the money is not there and they stop or suspend that dividend, you share in the failure of that company. If that company generates market appreciation and the stock price increases, you share in that gain. If the market responds negatively to that company and that company decreases, its share price decreases, again, below what you paid for it, you share in that failure. Let's compare that to preferred stocks. So preferred stocks, a class of corporate stock in which the investor has preferential rights over common to the dividends and company's assets. Now, if a company does want to create a separate share of shareholders, they can create preferred shareholders. Now, here you are going to receive preferential treatment. You're going to be one step above the common shareholder. This is going to allow you to be first entitled. If they say that you are entitled to dividends, you'll be the first one to get the dividend. If anything's left, it would go to the common holders. All right, when we talk about par value, we're going to talk about an arbitrary number specified in the company charter for each share of stock that is issued by the company. Looking in that corporate charter or looking on that stock certificate, it will tell you what's the par value. Again, that is an arbitrary number that the company set when that stock was issued. The most common par value is $1 per share. Now we know if you're looking at an Apple or a Google, or let's shoot the moon and say a Berkshire Hathaway right now for stock prices, we know that they have a higher market value than the par value. So remember, par value, an arbitrary number, it has no relation to the market value. All right, look at figure 20-1. This is the one that's going to show you a risk and reward chart. All right, so if we are to put So here, as we move up this spectrum, we are increasing the risk and hopefully increasing the amount of expected return. So again, if we just use this chart and we'll call this moderate, we'll call this conservative, and I'm going to call this aggressive up at the top. Give me some type of conservative, low risk, low expected return.
Certificates of deposit.
So we're going to put CDs down here. Has anyone invested in a CD lately? All right. Let me try to find a quick, try to apply some quick numbers here. So remember, the CD is going to be backed by the issuer of that CD, whether it be the bank. It's going to have some type of security behind it, something outstanding behind it, other than what was the intended use of the proceeds. All right, so the average CD. Hey, these numbers that I give you are as of yesterday, February 27th, or today, February 27th. Right now, across America, these sources are available at bankrate.com and at Bloomberg. So a one-year CD right now is paying 1.23%. All right, now let's look at a 5-year CD. It's paying 1.83%. I'm going to throw some different rates down here. A 5-year U.S. Treasury note is 1.8%. Note that it's a little less than what the CD. Here you have the full faith and credit of the United States government versus your bank. And I'm only focusing right now on fixed income. Okay, the 30-year bond. So this was the 5-year. The 30-year, 2.95%. Time representing a risk factor, you're going to receive more return for loaning that money to the government an extra 25 years. All right, if we don't focus on fixed income though, let's look at some other investment types for this diversified portfolio. What would be a good moderate investment?
Real estate.
Real estate.
All right, real estate. Again, we can't even be talking about a hard asset, a tangible asset backing this, something we can put our hand on. We know folks are not going to always just abandon across one big universal. Despite what you saw in 2008, there were people who did stay in their homes. All right, let's move on up this spectrum. What are some more?
Moderate.
Yeah, let's go on up the aggression. Let's go on up here to aggressive. All right, we see options and futures. You see stocks. mutual funds. All right, under real estate, you're going to see blue chip stocks. These are going to be your ones making up the Dow Jones Industrial Average. You're going to see municipal bonds. All right, we could even put U.S. Treasuries. We could put those down here. Again, as we move up the rate, as we increase risk, we will increase expected returns. And because of this increased risk, these types of issuers, you would only take on more risk if you had a higher expected return. So a municipal bond, those that are going to be issued by state and local governments. Again, not as secure as the United States government. Blue chips, these are stocks. These are going to be your GEs, your McDonald's, your Dow Chemical. I'm throwing these company names out here. Caterpillar. Companies with large market size, long histories, secure product, somewhere near the good product or the service model. We don't see it drying up. They have a positive outlook. Real estate. All right, now mutual funds versus stocks. Remember, this is referring to individual equities, whereas a mutual fund is going to take a pool of stocks and put them together. It's going to pull together some bonds. So again, creating a diversified model, it's going to own more than one issue. That's why we see it being, we would expect that it be less volatile. All the way up to options and futures. Who knows what a future contract is?
Business.
These are going to be, you will see these traded as well on an exchange. Okay, you can go up and look at the futures exchange. This is where you as an investor will make a calculated risk on where you expect something to happen in the future. So right now, I may be speculating what I expect the Florida orange crop to produce in 2018. I might be expecting what natural gas prices will do in the winter of 2017. Very common tool used in agriculture. When you think about farmers who have a lot of capital tied up in their crop, this can be a way for them to minimize risk. But as investors, it can also be a way for you to minimize risk. It can be a way for you to take and achieve higher gains. Now again, coming at the higher risk. A traditional futures contract, if I make a futures bid and think that a bushel of oranges is going to trade at whatever price in the future, and I let that futures contract realize, meaning I don't cancel it before it matures. They're going to ship me a bushel of oranges. Okay, now, when it comes to a trader, we really don't let many of those expire. We're going to cancel them out well before the expiration date, because I don't want 100 tons of crude oil shipped to my front door, nor would
I guess not.
expect a pipeline of natural gas feed it into my home.
Do a lot of investors do futures?
Do a lot of investors do futures?
I mean, is it widely used?
I would like to say that as you move down this or up this spectrum, this is where I would encourage you to use and seek out more guidance. Futures contracts are usually not traded by the average investor. But yes, institutional traders, those are going to be those with higher net worth. And corporations, institutions, they are going to trade on the futures contract. Your banks are trading currencies on the futures contracts. Those who have exposure into overseas markets and have to worry about currency exchanges, bringing money back into the United States. They can use these tools. I said you see it within farming. There are firms that only specialize in futures exchanges. Like I said, if you went and looked under the commodities index, you could see some of these that I'm talking about, but some common ones that you'll see traded are U.S. crude oil, West Texas Intermediate. Those are two types of major oil. Brent crude. Okay, Brent's going to be what you got coming out of Saudi Arabia and what's set by that price. West Texas is going to be those that are set by the West Texas oil industry. Natural gas are big ones, but there are futures contracts written on timber, on interest rates, on currencies, precious metals. So it's a pretty diverse arrangement there. All right, a stock certificate is over on Exhibit 20-2. And everyone see a stock certificate. What do you notice about the stock certificate? What I'm showing here is a stock certificate that is no longer traded, but this is stock in the Cleveland Indians. Those of you know that I've used baseball analogies in this class, but at one time the Cleveland Indians were a publicly traded entity. And I, just wanting a share of stock in the company, went out and purchased one share. You'll see the share quantity written in this box. You'll also see it written in the center of the certificate. But here it's going to show the name of the entity. It's going to show what type of stock. You also have circulated around a stock certificate in the Boston Celtics. It too, at one time, was a publicly traded entity. You see the number of shares, and it says that who is entitled to this stock. Charles Neal is the owner of one fully paid and non-transferable Class A common share. The par value can be listed down there at the bottom. This Cleveland Indian certificate was issued without a par value. Now, most investors are not going to, in today's traded economy, they're not going to hold on to actual certificates. Way back in history, there would be a time when every time you purchase stock, the company would send you your certificate. Back before there was good record keeping, guess what happened if you lost that stock? You lost your proof of ownership. All right, now, because of increases in technology for the last long time, throughout my career, there have been what's called a transfer agent who will keep track for these companies. They'll keep track of who their owners are on a daily basis, and they keep them updated. So even though you would request a certificate, there's still a digital record up at the transfer agent that's going to show who owns what.
Do you have to request a certificate, or would you automatically be sent one?
You right now would have to request the certificate. You probably have to pay a fee for delivery.
No.
Because you'd have to pay them to print it,
Of course.
and you'd have to pay them to mail it to you. A lot of what you see right now, you'll see a lot of older investors. I will say this number, those who come from the 1920s and 1930s, if they're still around, those would be ones that might request certificates.
Yeah.
those that suffered through the Great Depression and are very weary of trusting banks. But again, when you request that certificate, not only, it's not so much of the risk, but it's also decreases the liquidity of it. Think about it, if you wanted to sell that, you'd have to take that to a brokerage firm, have them open the account for you, you deposit the certificate, they would have to clear it in your name. That's going to take some time to settle that trade. And then you could be looking at 3 to 5 days before you could trade it. Whereas if you have just a digital record, you call your investment advisor and boom, they can execute the trade immediately. As long as it's during normal market hours. So I would say that you decrease the liquidity. Out of the certificates though, go out and look at them. Some are pretty cool. Walt Disney puts Mickey Mouse on the certificate. So you see a lot of parents, I've seen a lot of parents that will call up and order shares of Disney and request a certificate just so they can put that up. As I said, the two that I showed you here, both at that time were publicly traded. And to my knowledge, they were the only two United States professional organizations to be publicly traded. And that was during the late 1990s. And when they both decided that they were going to become off the public market, and I'll talk about Cleveland Indians. The Cleveland Indians was long-term held and owned by the Jacobs family. They went public. So they issued this stock. Well, shortly thereafter, in the probably early 2000s, late 1990s, early 2000s, the Jacobs family decided they were going to take the company private again. So what that meant was they had to go out and buy every share that was held in the public's hands. Now, me only holding one share, I can remember I paid around $7 for that stock, and the transfer was like $13. So I could have nearly doubled my money, but it was worth more for me just to hold on to that stock certificate and see a little piece of history in it. I think as time goes on, it'll be pretty cool. All right, any questions? All right, to distribute dividends on preferred and common stock. If you look to the board, we've got our first 4 steps that we are going to apply. So the first thing we're going to have to do is calculate dividends per share using preferred shares. Here, this will allow us to calculate the total preferred dividend. Then we're going to calculate the total common dividend. And again, we're able to calculate the dividend per share for each common share. All right, let's look at an example. A firm has 300,000 shares. $300,000 shares of $100 par, 7.5% cumulative preferred stock, and 5,200,000 shares of common stock. Now, what does it mean cumulative preferred? That's a new term. When I ask that you flip back a couple pages in your text.
Type of preferred stock that receives a dividend each year. When no dividends are paid 1 year, the amount owed accumulates and must be paid to cumulative preferred shareholders before any dividends can be paid to common shareholders.
Keyword, they accumulate. So this preferred stock is going to say they pay a dividend. Any given year, if the income is not there and the profits are not there to distribute, you as a shareholder are still entitled to it even though it doesn't pay out. So the next year, if they're gonna pay you 7.5%, what would they pay you? If they skip a year, what would they have to pay you in the second year?
Would be 15.
15%. So when you see cumulative preferred, they are going to accumulate. All right, so let's say that in this one, no dividends were declared last year, but $7 million. So we're going to pay $7 million has been declared this year. Calculate the amount of dividends due to the preferred shareholders and the dividends per share of the common stock. All right, let's first calculate dividends per share. So to calculate, we'll just repeat our steps down here. So dividend per share for the preferred is equal to the par value multiplied by the dividend rate. So your par value was just given at $100. What's the dividend rate? %7.5%. What's the dividend per share for the preferred? $7.50. Now, what's the total preferred dividend for that year? So the total preferred dividend the number of shares outstanding multiplied by the dividend per share. $300,000 shares outstanding. And what's the dividend per share? $7.50. So what's my total preferred dividend? Let's get these calculators out. $2,250,000. All right, now we didn't pay one last year, but this, our preferred, we just said, was cumulative preferred stock. So this is the dividend for the current year. But did we pay one last year? No. So let's not sum this just yet. We would have also owed $2,250,000 for the prior year. All right, so when you see cumulative preferred, we're going to have to go back and say that it is, when you skip a year, remember, you're going to have to go back and pay that year. Now, what's my total common dividend? So let's look here. The firm approved $7 million to pay in dividends. So the total common dividend can be solved for. The firm approved $7 million to be paid in dividends. How much did we just distribute in preferred dividends? 4.5 million. So what's the common dividend? $2.5 million. Now find what's the dividend per share. It says take the total common dividend and divide it by the total number of shares outstanding. So we would take this number here, this 2.5 million. What are we going to divide that by? Total number of shares outstanding. How many common shares we have outstanding? 5.2 million. So what is my dividend per share? $0.48. All right, flip over to table 20-3. I'll show you how to read the stock table out of the newspaper. What can you learn from that? Focus on McDonald's Corporation. What can you learn from McDonald's? All right, first you see the name of the corporation, McDonald's Corporation. You see its stock symbol. Equities are going to trade under a stock symbol. McDonald's MCD. You're going to see the opening price. What was the value of what was the market value per share when trading started for that day? You see what was the high for that day? What was the highest market value attained during the trading day? Column 5 is going to show you what was the low trading point. You're finally going to see the closing price and any net change for that day. Going further out, you'll see how much volume, that is how many shares exchanged hands for that trading day. Remember, the more shares that trade, the more high liquid that stock is. A lot of times we see small companies, small corporations. You might have heard of penny stocks, those that are on the pink sheets, these companies that trade for cents on the dollar. Those can be very thinly traded, not a lot of shares exchanging hands. So they are less liquid than something that's highly traded. Finally, we can see the 52-week high. The 52-week low. We'll look under column 12. 12 and 13 is going to show you what was the dividend. Based on that dividend divided by the market price is going to tell you what's the dividend yield. So as an investor, if you purchased on that day, based on that price, that's the amount of yield that current dividend would pay you. And I should point out, not every company does pay a dividend. Finally, you're going to see something about called a PE ratio. All right, let's see here. How would I solve for, before we do that, how will we solve for a current yield? So we said the annual dividend divided by the current market price. PE ratio, what's that?
Current price per share divided by earnings per share.
Current price per share. But what is it? Divided by what?
Earnings per share.
Earnings per share. All right, so the PE ratio is going to show us the relationship between the price of a stock and the company's earnings over the last 12 months. Typically, we see that companies that are trading at high PE ratios, that means that the market price is flying faster than their earnings. So as an investor, you're investing based off of those earnings. Okay, a low PE ratio is going to show you one who the market has not favored, but still has strong earnings. We could say that they could just be out of favor, but they still have strong earnings. You know, examples can be with oil companies. I mean, if we go back and look since 2008, you know, oil, let's just go back and say over the last 10 years, we've seen oil trade as high as $140 a barrel, and we've seen it all the way back down in the $30 range. You can bet that ExxonMobil still had strong earnings. Can be a factor that trades and changes the PE ratio. So this is a common factor when evaluating an investment. You know, if you want to use the Warren Buffett rule, this is one that you're going to pay close attention to. All right, so we've talked about stock exchanges. Commissions are going to be the fees charged for buying or selling the stock. That's going to vary. Okay, person who is going to make a market and trade these investments. Let's go back to call them a stockbroker. All right, this is someone who acts as an agent in buying and selling stocks or other securities. I could be an agent to anyone in this room if you called and said, purchase me stock in McDonald's. I act as a stockbroker. I go out on the exchange acting on your behalf and I acquire those shares for you. I would be acting as a stockbroker. I would charge you a fee for doing that. That would be the commission. That commission can be charged on a per share basis. It can be a percent of the total amount invested. I would always tell you that fee, if you're working with an individual, that fee, negotiate that fee. It can be negotiable. It should be negotiable. Working with an individual. Full service brokers. These are individuals that are going to provide research and investment advice in addition to assisting with a purchase or sale. The book tells you commissions generally range from 3 to 5% of the cost of each transaction. A discount broker is going to be one who simply executes the trade for you. They're going to charge somewhere between 1 and 2%. Now I can say since Congress, since the prior president enacted and put what was together a fiduciary rule. Now that has been tabled right now by the current administration, but we saw fees come down as a result of that, the enactment, or let's say the proposal of that rule. It was never enacted, but under the proposal, we saw fees decline. Remember, what you see in the textbook here are general assumptions. Each firm is going to set its own commission schedule. A round lot versus an odd lot. How many shares are we talking about with a round lot? 100. All right, odd lot is less than 100. It's not uncommon that a firm will charge you a higher percentage less than 100 shares. They want to receive them. Round lots. Yeah, in my opinion, it doesn't take any more to put the trade in. Just take this digit I'll have to push on the computer. All right, so calculating the cost of purchasing a stock. Okay, you're going to take the price per share, multiply it by the number of shares you're buying, or number of shares you're trading. Be sure you factor in the broker's commission. When you sell a stock, you execute the sell price, you take the number of shares, multiply it by the share price per share. It's going to receive the principal amount. On the sell side, you must subtract the broker's commission. All right, let's go back and revisit some bonds. Convertible bonds. We've talked about secured and unsecured bonds. Secured bonds are going to be those that are secured by some issuer, such as the United States government. Unsecured bonds are going to be those that don't provide any type of security. You're only secured by the full faith and credit of the issuer. It's not uncommon that issuers too sometimes purchase insurance on bonds. All right, convertible bonds. Bonds that can be converted or exchanged for a certain number of shares of common stock. So again, bonds, your bond could have a convertible feature to it, which means at specified dates or at your discretion, if the holder elects, they can exchange that bond for a number of shares of common stock. Callable bonds. The issuer here may declare and issue a 20-year bond. Okay, I will pick on, I'm just pulling companies out of a hat, but General Motors may decide that they are going to issue bonds in order to raise capital. Now think about this, when a company needs to expand or a company needs capital, I mean, there's various options, but one would be they issue equities or they issue bonds. Now, if they issue equities, they're going to dilute or increase the number of shareholders. If they are going to issue bonds, essentially they're issuing IOUs.
Oh, that's what I'm smelling.
And typically you'll see a company will have a variety of different ways in which they're raising capital based on their own structure. They're not going to be all equity. They're not going to issue all equity or going to issue all bonds. I can say in the last few years, as interest rates have plummeted, you've seen more companies eager to issue bonds because they're paying a lot lower interest rate right now. But a callable bond is one that I may issue a 20-year bond, and I may take your money and say, okay, class, I'm going to pay you a 5% yield for the next 20 years. 5% per year, I will pay you on this bond. But I'm going to have a callable feature within year 5. So at year 5, I have the right to come in and call that bond from you. That means I would pay you interest up to the 5 years. I'd usually put a teaser in there to compensate you for calling it early. That might be as part of the bond or the callable feature, but I would have you call that bond, you bring it back into me and redeem it. All right, the coupon rate is going to be that yield that we pay. We're going to say premiums and discounts. Okay, traditionally bonds will trade for $1,000 per unit. So per bond, we see them trading, when they're issued, a common price would be $1,000. If that bond, if the market value of that bond climbs above $1,000, we say that that bond is trading at a premium. Now, why would a bond trade above its issued value? If I issue a bond for $1,000, and this is over, we'll say 20 years, and I'm going to pay you, let's say interest rate was issued here at 2%. So how much interest am I going to pay you every year? Well, let's go all the way back. Let's make this 8%. So what's your interest payment?
$80.
So every year, all the way out to 20, I'm going to pay you $80. Now we just said interest rates plummeted, and they decreased as a result of increasing cash flow in the economy coming out of 2008. We've seen our Federal Reserve lower rates. We see them preparing to start raising them again. But they lowered rates. Can you imagine if, let's pick on GE. So here GE is issuing 20-year bonds at 8%. Now all of a sudden interest rates plummet. So let's say this is in year 2000. And in 2008, GE is going to issue bonds now at 3%. So here, the same $1,000 bond is only going to pay me $30 for 20 years. Which bond would you rather invest in?
First.
You'd rather invest in the first one. So in the open market, this bond becomes more attractive because of the higher yield. This would be a bond that I would expect, if we go to right now, in this time period, we saw in this 8 years, so you still have 12 years left. Okay, so I would expect this bond to raise to a premium. Again, it's more attractive because of that. Now, as the price rises, what would happen to the yield? Not the issued yield, but what would happen to the interest that you would receive? If you pay more than $1,000 for this bond, your amount of interest you receive will be less than 8%. So it will, apples to apples, it will rate in price, it will raise in premium to where the yield reflects the same as that issue. All right, Exhibit 20.4 is going to show you a bond certificate for Ford Motor Company. All right, you're going to notice that it looks similar to I didn't bring any bonds to show and tell. But again, the bonds are going to and be issued in certificate form 2 if you request. Exhibit 20.5 is the bond quotation table. And you're going to see a lot of the same common characteristics in the columns here. The name of the issuer, the symbol of that bond, the coupon, the maturity year, the rating. Look in column 5 and you see the ratings. So you're going to see the high and low here. Now look, the highest price for that trading day, here's Kraft Foods, we see 105.458. Now that bond is still trading. When you see that, know that you've got to multiply that by 10. Know that that bond, when you read this text, you're going to see that that bond is traded in a $1,000 unit, but it's going to be quoted in the paper in the hundreds. Be sure you make that adjustment when reporting your values. So that bond, if you called your broker up and you requested one bond, they are not going to just charge you $105. That's not what you're paying for that bond. Look in your text. What would you pay for that bond? $1,054. Notice how it's quoted to you, but notice how it differs in the trading price. So to condense it, to fit on these tables and condense it in its printed form, that's the only reason I can think of they quoted in the hundreds, but your trading price is going to be in the thousands. Remember, the most quoted price for the bonds is $1,000. So at $1,054, that's a premium. Even on the low, 1,050, that's a premium. We see the last, we see the yield. Bless you. Any questions about it? I see any questions about being quoted on, being printed and shown in the paper in the 100s? And even if you called this way, if two traders are speaking to one another, they're even going to say, I've got a Kraft bond at 105. And I can assure you there have been a lot of rookie stockbrokers who have put that figure in there, not realizing. All right. You know, I'll tell you a bond that if you want to know some cool history, you can also go back. There was a top of bond issued back in the, I might say all the way back in the 1800s. Probably didn't see them somewhere through the mid 20th century. We saw this type of issue become less relevant. But has anyone ever heard of a bearer bond?
Yeah, I've heard of it.
All right, a bearer bond was one that was created to hide the identity of the holder.
Mm.
So remember I said if you own stock, in today's economy, there's a transfer agent there who has your name transcribed and the number of shares that you own, and they're reporting that to the issuer. Same idea with the bonds. But a bearer bond was issued and a certificate was mailed, and it was called a bearer bond, and it had that printed. To the bearer of this bond is entitled to, and the terms were specified. There were no transfer agent holding the numbers back there. Now you can imagine why our taxing authorities do not like this. Well, they don't know if it's received income. 2, what do you think happened in the Wild Wild West? These railroad companies were issuing bearer bonds. These wealthy individuals were having these bearer bonds and they were rolling it up, putting it in their sock. And what happened? The Wild West got them. As Wild West knew, as long as they held on to, they got that certificate and they held on to it, they could go back to the issuer once a year and say, I'm the bearer. Give me my annual interest. So there's probably some less than shady things going on. You still see some bearer bonds that are hanging on. You might run into one. I don't know of anybody who's currently issuing them, but kind of a good little part of American history. All right, let's look at something about purchasing bonds. All right, what do we need to consider when we purchase a bond? Remember how bond works. Accrued interest, let's look at this factor. When bonds are traded between the stated interest payment dates, interest accumulated from the last payment date must be paid to the seller by the buyer. So let's look at an example. What are we going to do first? We're going to calculate what?
Calculate the accrued interest on the bond.
Calculate the accrued interest on the bond since the last payment date using interest is equal to, what's PRT?
Principal rate time.
Principal rate and time. This can tell us the next will solve the price to purchase. So here we're going to take the current market price plus accrued interest plus any commission. Remember to factor in that commission. And in step 3, we can calculate the total price. So remember, you're going to have to first calculate the accrued interest. The accrued interest, we're going to assume here that the bond is trading between its interest payment dates. And we're going to have some settlement between the buyer and the seller. All right, let's look at a price. Silver Lake Corporation has 20. We're going to say right here. We're going to have 20 bonds with a coupon rate of 6.25%. Current market price, 91.375. Commission charge is going to be $10. And it's important to say that's going to be $10 per bond. The date of the transaction is October 1, and the bond pays interest on February and August. So it's going to pay this interest on February 1st and August the 1st. But on October 1st, we're going to purchase 20 of these bonds. So we're going to say that we've got to look at the settlement period between this August date and this February date. So what's the amount of accrued interest? How would we solve for this?
Take 1,000,
1,000 being the issue price.
multiply that by your percent, 6.25.
Multiplied by
6.25.
multiplied by the rate.
And then your time, which is going to be
What?
6/12. Would it be between February and August, the months?
No, look. How many months are we going to have? Let's just use two parties here. Party A is currently holding the bond and B's buying it. A would have received their August interest payment. So the holder already received that.
Okay.
We'll say the seller already received that payment. Now, 2 months later, the buyer purchases it. But look, from August 1st to October 1st, we have an accrued interest amount. Meaning if this investor, if the seller continue to hold this bond to February, they're going to receive their next payment date. I'll point out it's very common that bonds make two payments per year. So that the seller received the August payment, but we go out to October 1st, there becomes 2 months of accrued interest
Do over 12.
that they're gonna have to solve for. So our accrued interest amount becomes $10.42. All right, we just did this. Now, what's the price to purchase the bond? What's the current market price? What's the current market price? All right, I'll tell you, this bond's trading at a discount. Here was your market price. Remember, when you see this quoted, you're going to want to move that decimal over 1 spot. So this bond is trading at $913.75. Plus the amount of accrued interest. We just said was $10.42. All right, so the price to purchase per bond is $934.17. The buyer is going to have to pay the current market price plus the amount of accrued interest. Now, in this problem, I've not given you a broker's commission. But if you had a broker's commission, you would add that on to this example. All right, now what is the total purchase price? So this is the price to purchase per bond.
When you multiply it times how many bonds?
So the total purchase price, we are going to take the price per bond, $934.17, and we said we wanted to buy 20. What does that yield?
Comes to $18,683.40.
Should be 19,000.
934.17 times 20.
Yeah, take that, unless I'm doing this wrong.
18,683.
I'll take your calculator over my mind right now. So $18,683.40 to purchase that bond. Now again, what if there was a broker's commission, $10 per bond? How would we, what else must we add on that?
Broker's commission of what?
So if we had a broker's commission of $10,
Then you would add.
remember it would be quoted as 10 per bond. So up here, we would have had this plus
$10.
10 on the price per bond. And here, we'd have to take the 20 bonds and multiply that by $10 as well. All right, that's going to assume we were buying a bond. What about if we want to sell a bond? So remember, as the buyer, that seller just paid us the amount of accrued interest. All right, so let's look at an example of a sale of 5 bonds. Coupon rate of 8.875. The market price of $99. All right, the commission charge on this one is going to be $10 per bond. So this one is going to have a commission charge. And the date of the payment, the date of the transaction is 122 days since the last interest payment. What's the amount of accrued interest? How would we solve for that? Remember, what was the issue price?
1,000
You're going to assume it was 1,000
times 8,
times the rate.
yeah, wait,
What's my rate?
8.885.
Now, what's my time?
142 days.
122 days.
360.
There's 2 rules that will apply. We're going to call this a banker's rule, and we talked about that, 360. If we're looking at an exact interest rate, 365. Okay, so now what are the proceeds equal to?
Current market price plus the accrued interest minus commission.
So the current market price plus accrued interest plus commission. All right, so what are we going to say the proceeds are? What's the current market price? Not $99. Remember to move that decimal.
990.
909. All right, first we need to solve up here. This is 30. So I want to take the current market price. I want to add in the amount of accrued interest. And what else do I want to add?
Minus commission.
Minus commission. Be sure you subtract the commission. And we're looking at the proceeds per bond right now. Want to tell me what that is? Nine what?
Sorry, just on
1,010.86.
I was gonna say, I know it's gonna be over.
0808. I corrected myself.
You corrected, no O's.
Yes.
All right, total proceeds. Now, what are my total proceeds? Remember, we're gonna take this factor. We said we traded 5 bonds. All right, current yield. Y'all know how to solve for a current yield. All right, give you an example. Give me a current yield on a bond with a coupon rate of 9.375. Currently selling at a discount of 84.75. So the coupon rate, 9.375. Currently trading at a discount at 84.75.
You said 9.375?
Yeah, the current yield, 9.375%. And we're going to say it's trading at a discount at 84.75. What would be the stated interest? Think of a bond, you're going to have to first calculate what is the interest rate at par. Dollars.
0.09375.
So at par, my bond is going to pay an interest payment of $93.75. Now, if I want to look at the current yield, so at the time that this was issued, someone bought this and invested in this bond. They were entitled to, as the holder, $93.75. But now that it's trading, remember, it's been subject to market fluctuations. We find it now trading at a discount. So if a new investor just purchased this, what would their yield be? All right, I can tell you, you're going to want to take the interest payment per year. They're still going to receive, regardless of it trading at a discount, they're still going to receive the interest rate that was stated on the bond. Now, what's the amount that they're going to pay for this bond? $847.50. So look, when it traded at a discount, and as the purchaser, your current yield on this investment is 11.1%. The stated yield at issue was 9.375. The reason a higher yield, we paid less for the bond. If we were looking at a bond that was trading at a premium, it's going to decrease. Your current yield would be less than. So if you're paying a premium for it, you're going to earn less than. Remember that example I put back up there of how they're going to trade. All right, mutual funds. Somebody tell me what a mutual fund is. We'll be wrapping up soon.
Fund that invests in a lot of different kinds of stocks, bonds.
Invest in a lot of stocks or bonds. But also a unique factor in it is that it pulls investors' money together before it puts that purchase out. So if you go to a mutual fund company, and I'll pick on Fidelity. If all of you go together and you were to invest in the Fidelity Contra Fund, and all of you make a purchase, all of your money in this class is going to get lumped together, and the portfolio manager of the Contra Fund is going to go and make that purchase, pulling all of your money together. They're going to separate it and report it to you. After all the money's been pulled, they're going to separate it and report to you your individual share of that total pot of money. Sometimes you'll see quoted NAV, net asset value. This is the dollar value of one share of the fund's stock. So when you sell or you buy, the NAV is the price that you will pay. And we're ignoring any type of commission right now. The offering price, the price per share when investors pay when purchasing a mutual fund. So the offering price is going to include the NAV plus the broker's commission. A lot of times you'll see in mutual funds quoted a load. Okay, the commission is usually reported when you're talking about mutual funds. You're going to see might be reported as the load. That's the sales charge or a broker's commission. So if that stockbroker institutes that trade for you, the load is the amount of commission they receive. A front-end load is one that you will pay up front above and beyond the NAV. The back-end load is going to be assessed when you sell the fund. Now, a lot of times you'll see mutual funds quoted in different share classes. And I'll tell you, it's common if you see an A share, probably looking at a front-end load. B shares, back-end loads. In popularity, we've seen a decline in recent years of B shares. There are other share classes out there, but we've just seen a decline in the popularity. It's interesting how investors forget, they buy the fund, invest in the fund, they pay no load. They might hold it for 5 years and they forget, or it was not communicated clearly, that when they sell it, a load must be deducted from the proceeds before you receive anything from the sale. And we've seen B shares decline in popularity. Table 20-6 is going to show you a mutual fund quotation, very similar to what you've seen in the stock and the bond. All right, how am I going to calculate sales charge percentages? So if there are a load here assessed on the sales charge, the book doesn't tell you this, but you'll also notice in the fund company, mutual funds will charge you operating expenses as well. The loads typically go to the broker who transacted the trade. The operating expenses are those reoccurring charges that the fund company collects. That's where the fund company makes its money. Typical typical A share front end load funds be anywhere from 3 to 5%. B shares.
Checking on that. Okay.
Check on that, Siri.
The work for share bond loan funds be anywhere from 3 to 5%. Take a look.
So B shares are going to show you, usually when those were quoted, those were even on a declining Most common, when they were popular, I'll say when they were last popular, a declining 7-year schedule. So if you sold it in the first year, you paid a 7% load, declined annually by 1 percentage points. Okay, and you might also be holding C share classes in your portfolios as well. And a C class is going to be a no load fund that charges a higher annual operating expense. So both the broker and the fund company are paid out of and that charge may be hover around 1%. All right, if you'll refer to the text, it's going to show you to calculate the yield on a mutual fund. Again, I wouldn't introduce anything new to you. The last thing I want to introduce to you, return on investment. Somebody tell me, what is ROI?
Basic measure of how an investment is doing. Used to compare various investments on an equal basis, calculated as a percent by dividing the total gain on the investment by the total cost of purchase.
A way to gauge and calculate the performance of an investment. What was the return on making that investment? Now that can be a gain or a loss. Okay, and how you would get that is taking the proceeds that you receive from the buyer or the sell, subtracting out the total cost of that buy or sell. Now to calculate the return of investment, you're going to take that total gain or loss and divide it by the total cost. All right, Peggy purchased 2,000 shares. So we're going to say Peggy purchases 2,000 shares of a fund with an offering price of $8.60. What's the offering price? NAV plus broker's commission. So your broker's commission is already summed up here. She later sold, so she bought at $8.60, and she's going to sell at an NAV of $9.18. During the time Peg owned the shares, the fund paid her dividends of 27 cents. Let's say 42 cents. What's her return on investment? All right, first off, what was her total cost? That's what we've got to solve for.
So your 2,000 shares.
Multiplied by $8.60. $1,700. What was her return from the sale? 9. $18,360. All right, what's working or loss?
Proceeds, total cost.
We want to take total proceeds from the sale minus the total cost. What's our gain? $1,160. Now let's see here. What else do we have to consider? We got to take dividend number 1 And that she received 2,000 shares multiplied by 27 cents. So what'd she get off her first one?
$140.
$540. Then we gotta consider dividend number 2. Here, for her 2,000 shares, she received a dividend of
$840.
42 cents, is $840. So now, what was her total dividends and her gain? $1,380. Now we're ready to solve for the return on investment. Well, no, wait. Take dividends and add it to that. Take those three numbers and add them together. Your total dividends are 1,380. But take the dividends and add it to the 2,000 what? $2,540. All right, so your total gain, we're going to take 2,540. What are we going to divide that by? Your total cost of purchase, 17,200. .1476.
Yes. So 14.77.
14.76%.
Would you round that number?
Would you round the number? I mean, the book's going to show you everything carried out to decimal places. Because we're dealing with dollars, and because this being I would always go out 2 decimal places. What's ironic, if you take if you take econ for me, I'll probably suggest you go out 30.
No, that's what I'm saying, like 14.7, would you make that a 7? 14.77.
So the actual calculation comes to 0.414767.
So would you round that 6 to a 7 or leave it a 6?
Would you round it this last digit to a 6 or a 7? I just kept it at 6. If you want to round it, I don't think 1 penny. I'm not going to deduct for 1 penny. All right. That concludes chapter 20.